Real estate investment trusts have been incredibly closely correlated with interest rates over the past years. As rates surged, REITs crashed, and now as interest rates are being cut, REITs are recovering. I'll put a chart on the screen where you'll see this near perfect inverse correlation between REITs and interest rates. Because of this, I think that now is a great time to be investing in REITs. They have already surged by about 35% in anticipation of the first rate cut, which happened about a month ago, but there will be many more of them, and the next rate cut is already in a few weeks from now. It's expected to take place on November 7th. The debt market is today pricing an 80% chance that the Fed will again cut interest rates by 50 basis points on November 7th, and after that it's also expecting another 150 basis points of rate cuts in 2025. This means that interest rates could drop into the low threes within just a year from now, and I think that this is very bullish for the REIT sector. Today there are still many REITs that are heavily discounted because they missed out on the recent rally, and they could present significant upside potential as the Fed keeps cutting interest rates over the next year. In today's video I'm going to discuss two of my favorite REIT investment opportunities to buy in anticipation of the rate cut of November 7th. Hey everyone, this is Jussi. I run a small investment firm that specializes in REIT investing, and before I go into this video, I want to kindly ask you if you could please click the like button. That helps me a lot to produce all this free content for you. Thanks so much in advance. So the first company that I'm going to discuss here is called Armada Hoffler Properties. Its ticker symbol is AHH. The company just recently announced a new equity offering, and it caused its share price to dip by about 8%, and as a result of this, its share price is now back to where it was about 1 year ago, and it has essentially missed out on the recent REIT rally. We think that this is a great buying opportunity for long-term oriented shareholders, and for this reason we bought the dip at High Yield Landlord. By the way, if you want to access our full portfolio, we're offering a 2-week free trial. It will be the first link in the description of this video. Such negative initial reactions to equity offerings are very typical in the REIT sector, but if this capital can be put to good use, it will eventually create value for shareholders. Armada Hoffler plans to use this equity to deleverage its balance sheet in preparation of its new development projects. As a reminder, Armada Hoffler is an active developer that has historically been able to build new projects, earning very high initial yields on its capital, and in a way it has a competitive advantage here because it's building so much that it has its own construction crew. It's even offering construction services to other investors, and as a result it's able to build at a lower cost than most of its competitors. Moreover, already today the REIT owns a lot of land in prime locations, so it doesn't have to buy this land to start building. It can now just start developing it, and therefore the initial yield on this investment capital should be very high. There is still going to be a dilutive impact over the short run, and it's going to impact the next quarter, next year's result, and this is why the market hates it. Most market participants are very short-term oriented, but if you look a few years out, I wouldn't expect it to have any major impact because Armada Hoffler is able to deploy this capital at such high rates of returns. Ultimately, the company has a great track record, so I trust the judgment of the management. I'll put a chart on the screen where you'll see their performance since they IPO up until the pandemic crash, which started to hurt their market sentiment. You'll see there that it has massively outperformed the Vanguard Real Estate ETF, which is representative of the average of the REIT sector. So ignoring this short-term bumpiness, I think that this is a great buying opportunity for long-term oriented investors. Armada Hoffler owns mostly Class A mixed-use properties, with about 2/3 of its rental income coming from residential and service-oriented retail properties. I love that they recently reclassified their properties as mixed-use in their investor presentations, because I think that this is something that's clearly underappreciated by the market. These mixed-use properties typically combine different uses. They combine retail, residential, and office under one roof. Again, I'll put a few pictures of such properties here so that you see how it looks like, but these properties are very desirable because the different uses have significant synergies when they're in close proximity to one another. It makes the location more convenient, it makes it walkable, more lively, and as a result there is typically high demand for this type of properties, and it results in faster rent growth. I think that this will be especially true in the future because of the shift to a hybrid work environment, and companies will have to heavily reinvest in their offices to make them more desirable, to attract and retain talent, and I think that this will greatly benefit this type of live, work, play, mixed-use properties. I believe that puts Armada Hoffler in a great position to enjoy above average organic growth in the coming years, but despite that it's today priced at just 8.7 times its FFO, which is probably the lowest multiple of any REIT that owns such Class A properties. At its peak, analysts were estimating its net asset value per share to be about $20 per share, and yet it's today trading at just about half of that. Admittedly, cap rates have expanded a bit since then, but rents have also grown. I think that its net asset value has dropped somewhat, but even then we still estimate that it's priced at a roughly 30 to 35% discount to its current net asset value. Finally, it's also offering a near 8% dividend yield with a conservative 65% payout ratio. So why is it so cheap? And I think that the answer is clear. Most investors perceive Armada Hoffler to be a small, diversified REIT that lacks focus, has significant exposure to office properties, and a bit higher leverage than usual. Typically, such REITs that lack focus, especially those that have exposure to office properties and higher leverage in this environment, tend to trade at a significant discount to the average of the REIT sector, and this is also the case here. However, what I think that the market has missed here is that Armada Hoffler is focusing on these mixed-use properties, and that makes the story completely different. Now the REIT is finally working on rebranding the company in order to correct these misperceptions, and at the same time it's also lowering its leverage, and I think that both of these things should benefit its market sentiment going forward. It will of course take time to change perceptions, but in the meantime we're earning a 7.6% dividend yield, and the company's net asset value is also expected to keep on growing by about 5% per year going forward. But really the main reason to invest in the company is the expectation that FFO multiple will eventually recover and catch up to the average of the REIT sector. Interest rates have come down significantly already, and they expect it to come down a lot further, and yet it still hasn't recovered like other REITs have. I just find it hard to believe that Armada Hoffler wouldn't eventually catch up, especially as it rebrands itself and achieves a better market sentiment. Again, it's priced at just 8.7 times FFO. Even just returning to about 14 times will unlock 50% from here. It will still trade at a sizable discount to most other REITs that own Class A properties. Therefore, I think that the risk reward is very attractive here, and this is one of my favorite REITs to buy today in anticipation of the next rate cuts. The second company that I'm going to discuss now is called RCI Hospitality. Its ticker symbol is RICK. I'm going to keep this one shorter because I'm working on a separate video on this company, but in short, RCI is not a REIT, but it's a REIT-like entity that essentially functions as if it was a REIT. It's buying real estate, it's operating it similarly as hotel REITs would do, but instead of buying hotels, it's buying mostly adult nightclubs. And just like REITs, it owns a lot of real estate, has some debt on its balance sheet, and therefore the surge in interest rates has also impacted its market sentiment. So far, the shares of the company have mostly missed out on the recent rally, and therefore I think that now is a good time to accumulate more of them ahead of the next rate cut. I just recently interviewed the CEO of the company, Eric Langman, for our REIT newsletter, High Yield Landlord, and I really like what he had to say. By the way, I have temporarily removed the paywall for this interview so that all of you can access it. It will be one of the links in the description. Also make sure to sign up for the free tier of our newsletter to not miss this type of content in the future. There are three key takeaways for me. The first one is that I expect them to announce new club acquisitions in the near term, and I think that this will significantly boost their market sentiment. Secondly, they are planning to unveil a new 5-year plan later this year, and according to my own calculations, it will seem that they expect to roughly double their free cash flow on a per share basis in the next 5 years, and this would price the company at an incredibly low free cash flow multiple. Already today it's priced at just 7 to 8 times, so if they double it from here, it will be priced at just around 4 times. The third takeaway is that the shares are today already incredibly cheap, trading at a roughly 15% free cash flow yield or even higher. And the company is able to take advantage of this by buying back shares quite aggressively. They just recently also reported their results, and we saw there that there was a significant acceleration in buybacks. And this is happening because they are priced at such a low valuation, and the company takes advantage of this. At this pace, they should be able to buy back nearly 10% of the company in just 1 year. Ultimately, I think that the impatience of the market has created an amazing opportunity for long-term oriented investors, and therefore I've bought a lot more RCI over the past months and year. I expect it to be one of my best performing holding over the next 5 to 10 years. Its business experienced some bumpiness due to the pandemic and then the surge in interest rates, the post-COVID normalization period, but things are now looking up from here in my opinion, and yet its valuation is still heavily discounted. Now, if you want to learn more about what other companies we are buying, as I said earlier, we're offering a 2-week free trial to our REIT newsletter. It will give you immediate access to our full portfolio, all our trade alerts in real time, our CEO interviews. There are a lot of them. We posted about 10 interviews over the past month alone. You'll be the first link in the description of this video. And otherwise, once more, if you could please click the like button, that will help me a lot to keep on growing. Thanks so much in advance. See you at my next one. Bye-bye.